Hi, I'm Linda Eedes, and this is an update on the RECM Balanced Fund, focusing specifically on the third quarter of this year. So the fund had another good quarter. It was up just over 3% for the quarter relative to its benchmark, which is CPI plus 5%, which was up just under 2%. The global portion of this fund is really where the returns came from over the quarter. The fund now actually has about 28% global. That's obviously slightly in excess of the 25%, largely as a result of the fact that those stocks have done very well, and of course the rand depreciated over the course of the quarter as well. But increasingly we have actually been allocating more to the global part of this portfolio, whereas a year and a half ago we actually hadn't made full use of our global allocation. That was exactly the right way to be positioned. The rand actually, contrary to what you might have expected given all the sort of political noise, actually has strengthened significantly over the last year and a half. Having had that happen, we then saw an opportunity to start allocating again to the global portion of this portfolio. And what's great is that the global portion is made up of a really nicely diversified set of investment ideas in good, high-quality businesses, many of them oriented away from a lot of the sort of parts of the market that are starting to feel a bit more precarious. And there I'm specifically referring to a lot of the US companies in particular. So the local portion of the portfolio did come under a little bit of pressure. What's interesting about the local market is that actually if you look at the JSE All Share Index, it's up just over 12.5% for the year to date, which sounds pretty spectacular. But if you consider that NASPAS, which makes up 18% of the index, was up 46%, which means that almost 2/3 of that 12.5% was NASPAS alone. And then if you add the fact that Richemont, which makes up 6% of the All Share Index, was also up about 36% during the year to date. If you just take those two stocks alone, that actually captures 80% of the positive returns that you've seen for the year to date. So what that's telling you is that looking at the overall index return isn't really a reflection of what's happening on the ground in South Africa. If you look at a lot of the local businesses, the more domestically focused businesses, they've actually come under pressure, and that you might expect given what's happening on the local front. But therein lies an opportunity as well. So many of the businesses that we've been increasing our exposure to on the local side are businesses which are the stronger businesses which will weather the storm effectively. Many of those in the industrial parts of the market which have been through a very tough time over the last few years. We do happen to own businesses like Richemont. You may recall that not so long ago they were actually slightly out of favor because of the knock-on effect of sort of China on luxury goods sales and the likes. And of course that's a fantastic business, and we took the opportunity to actually buy that stock in our portfolio. And now with it having done so well, we've obviously been pulling that exposure back as well. So if you look at the Balanced Fund, it's actually sort of making full use of its global allocation, which we think is a good thing right now. But it also has a portfolio of very nice local businesses, which have obviously now been much strengthened by the tough time that they've been through. And remembering that through every adverse kind of market environment, there are those that actually will capitalize on the opportunities, which by virtue of being stronger businesses will actually benefit from the demise of other smaller, weaker businesses. And that's really where we're focusing our attention. Also on those businesses that actually benefit by being in a market environment where government is failing to deliver. And there I'm thinking of businesses like, for instance, Life Healthcare Group, which obviously is the hospital group which provides private hospitalization to a lot of South Africans. So within sort of the adverse circumstances that South Africa finds ourselves in, there are opportunities which are created by that as well. And that's really what one wants to find within the local opportunity set. Speaking a little bit to that theme in some ways, if we look at the new stocks in the portfolio, on the global side we've introduced three retailers in fact, but in very different areas of the market and in different geographies as it turns out as well. So the first of those is the US luxury homewares retailer Williams-Sonoma. This is a fantastic business. It's generated returns on equity in excess of 18%. over its cost of equity. It's a business that we were able to buy at a PE of 13. It's got a dividend yield of 3.5%. So this is actually a fantastic bargain for a very high quality business. Similarly, if you look at the other two new stocks on the global side, they are also great businesses. Carpetright, which actually has almost a third of the sort of carpeting and flooring market in the UK, and Next, which is the biggest clothing retailer in the UK, both on the high street and online as well. And these businesses, all three of them, have actually obviously gone through a bit of a knock-on effect of going through a cyclical downturn, particularly for consumers across all three of those spaces, and that's obviously impacted the business in the short term. What the market tends to do is extrapolate the sort of current circumstances ad infinitum, and what we want to do is actually look through that cycle, buy the businesses that will actually sort of do very well over time, but at a point in the cycle where the price is reflecting the sort of more shorter term orientation of most investment managers. So all three of those businesses are businesses that we're very comfortable with, that we think we've got at very, very attractive prices. On the local side, I think the most significant change is that we've introduced FirstRand into the portfolio. There, again, we're looking at the business cycle of that business, which obviously in the South African banking sector, if you look at credit demand, that's kind of the lifeblood of banks, and that does remain fairly muted. You can see that in terms of where they are in the cycle, they're not actually far off, banks as a whole, from where they were sort of after the financial crisis. So, you know, as a value manager, you really want to be having some exposure to that sector. What differentiates FirstRand is that if you actually look at their track record of excess returns over their sort of cost of equity over time, at the current price to book ratio, what that's pricing in is growth of around 10 to 12% from this point onwards. And we think that given where we are in the business cycle or the banking cycle, that seems very reasonable, and obviously it provides you with an opportunity to actually buy sort of a fantastic bank. So that's where our primary banking exposure is on the local side. So if we look at the RECM Balanced Fund as a whole, I think what's great is that over the last 2 years, we've really been able to move from a portfolio that was quite highly concentrated in, as it turned out, quite a volatile, in fact very volatile part of the market, which was the resources space, and that has now come through into the portfolio, and we've realized a lot of those gains and sold those positions down, and we've replaced that with a far more diversified set of investment opportunities across the board. So that's globally and locally as well. And I think what's great as well is that the actual kind of overall quality of the portfolio has also improved as we've been able to move away from those very sort of cyclical, very kind of volatile businesses. So that feels very comfortable in terms of sort of holding that portfolio of assets compared to sort of the assets that you might have had to hold as a value manager 2 years ago. In addition to that, I think any portfolio which is positioned away from the market, away from sort of the biggest constituents of the indices locally and globally, is where you want to be. That return to value is coming through. We're seeing that impacting the returns across the board, across all of our funds, in fact. And one wants to really sort of move in that direction, away from the parts of the market which really have significant risk of permanent capital loss. So the RECM Balanced Fund is a well-diversified, robust portfolio of undervalued opportunities. It's taking advantage of that sort of return to value, as I mentioned, and we believe that this fund will do incredibly well from this point onwards as a result.